Okay, so this next video lecture is still the continuation of our module 2, tax or income tax for individuals. So we are now in the categories of income and the tax rates. So income, when we say income here, this is the gain derived from capital, from labor, or from both, okay, combined. Meaning, when we say income, this refers to the profit that you gain from doing business. For example, selling a product or rendering of services to your customers. An income can also be in the form of salary or compensation in the case if you are an employee, okay, who works for an employer. So that is also considered as income. Or an individual can also derive income from having a business and at the same time working for the employer, and he has a salary. Okay, so provided that it be understood to include profit gain through a sale or conversion of capital assets. So income can also be coming from selling your real estate property, like your land, your building, and other assets. Okay, so that can also be a source of income. So again, income may be coming from the profit that you gained from doing business by selling goods or rendering of services to your customers. Income coming from your salary from working as an employee to your employer, and income coming from the sale of your capital assets. So those are the main sources of income of an individual. Okay, so for the nature of income, income is a flow of or this may be coming from the rendering of services. Okay, so by the capital that you used, okay, by the payment of money from it or any other benefit, okay, that you derived from such engagement or business or endeavor, okay, in a period of time. So what is income recognized? So here, under the realization principle, so revenue is generally recognized when both of the following conditions are met. So meaning, if these conditions are met, then it is assumed that you have recognized or realized an income. First, the earning process is complete or virtually complete, meaning if you are a seller, you already delivered the goods to your customer. Or if you are a service type of business, you already rendered the services to your customers or clients. So the earning process is already complete, or there is a transfer already of ownership from the seller to buyer. Second is an exchange has taken place. So this principle requires that the revenue must be earned before it is recorded. So earned meaning you have already delivered and rendered, okay, to your clients or customers. That is what we mean by income is recognized. So the question is, when is your income taxable? So we also have here the requisites, okay, that must be present before an income will be taxable. First, there is income, of course. So any gain or profit or salary compensation and the others or the like. Second, the income, the gain or the profit is received or realized during the year. Okay, so meaning you already received it, or you have already rendered your service or transferred the ownership to the buyer, okay, during the year, okay, for you to realize your income. So if that is the case, then that income earned is now subject to tax. And the third is the income, gain, or profit is not exempted from our income tax, of course. Because if your income is exempted, then you will not be, or your income is not subject to tax. Okay, so these are the requisites of an income to be taxable. Okay, so what do we mean by gross income? So we mentioned it before in our sources of income. When we say gross income, this refers to all of the income that you derive from whatever source, okay, which includes and not limited to the following. So again, gross is total or all of your income derived from whatever source, okay. So this may include but not limited to the following. First, compensation or salary for the services in whatever form paid, including but not limited to fees, salaries, wages, commission, and similar items. Second, your gross income from the conduct of trade or business or exercise of a profession. Meaning, in number 2, this is an income that you derive in doing your business, selling your products or services to your customers. Third is income or coming from the gains derived from dealings in property, meaning you sold your real estate or your real properties like your land, your building, your house, and the like. If you have derived any gain from that sale, then that is part of your gross income, which later on is also subject to income tax. Interest earned. So, for example, if you deposited in the bank, so your deposit earns interest, so that is subject to income or part of your gross income. If you lend a money, or if you are a creditor and you lend the money, okay, to someone and earns interest from it, then that is also part of your gross income, which is subject later on for taxation. Rents, okay, if you are renting a house, okay, or a property, so that is also a form of income. Royalty, so royalty is, for example, you wrote a book, okay, and then there is a bookstore who sells your books. So every time that there is a sale, you gain a percentage of that sale. So that is an example of royalty. Okay, so that is again a form of income which is subject to tax. Dividends, so if you are investing in a company or in a corporation, so the dividends that the corporation is sharing with you, okay, or giving you, that is also your income and subject to tax. So you also have your annuities, okay, prizes and winnings, pension, partners, distributive share of net income. So in number 11, this is what we call also just like the dividend, but dividend is in the case of a corporation. While in number 11, this is for the share of your income from a partnership. Okay, so this is these are the different sources of income aside from those we've mentioned before. Okay, so all of these are subject to tax. Okay, so of course, if you win, okay, there are still taxes due, okay, from it. So later on, you will understand as we go along, because this is subject to a fixed rate, okay, and is classified as passive income. Okay, so pensions also and the like. So those are the different sources of your income which may be subject to income tax. So what is the concept of income from whatever source? So what do we mean by this phrase? Income from whatever source derived. So this is a legislative policy to include all income not expressly exempted within the class of taxable income under our laws. Meaning, if that income is not subject to exemption, then that will be included, or that should be included in your taxable income. Okay. So distinguish gross income with net income and taxable income. When we say gross income, this is the total or all of your income. Net income is this is gross income minus our business expenses or expenses, okay, in the income statement. That is your net income. While your taxable income is gross income, okay, minus the allowable deductions provided in our tax laws. That is equal to taxable income. So please take note of the difference between that. Okay. What is compensation income? So we have here the definition, but in simple terms, when you say compensation income, these are the income that you derive in performing your services as an employee to your employer. Okay, so meaning this is under the employer-employee relationship. So this is in the form of salaries, wages, okay, emoluments, honoraria, allowances, and so on. Okay, so it should be under an employer-employee relationship. That is compensation. What about fringe benefits? Okay, so when we say fringe benefits, this is any good or service or other benefit furnished or granted in cash or in kind by the employer. This is aside from your compensation. So, this is normally fringe benefits are normally given to the top level management. So the rank and file employees is not given this type of benefits. Okay. So what is an example of fringe benefits that the employee or the top management employee can receive? So this is in the form of housing, expense account, meaning there is a allowance given for expenses. Okay, vehicle in any kind, household personnel such as maid, driver, and others. So your employer can provide it for you. But again, this is given to the top level management employee. Okay, and number 5, interest on loan at less than the market rate to the extent of the difference between the market rate and the actual granted rate, or in other words, interest that is lower than what is the usual. Okay, so this is the example. Okay, so we also have fringe benefits in the form of membership fees, dues, and other expenses that is paid by your employer in your behalf. Okay, expenses for foreign travels, holiday and vacation expenses, education assistance to the dependents of the employee, and the life or health insurance, and others. Okay, so those are the different benefits, okay, that the employer can provide to the top level management. So this is what we call fringe benefits. Okay, so what are the non-taxable? Or the question is fringe benefits taxable? So we have here the following. Okay, so a fringe benefit is non-taxable if these fringe benefits are authorized and exempted from our tax or special laws. Okay. Second, if contributions of the employer for the benefit of the employee to retirement, insurance, and hospitalization benefit plans. So only those fringe benefits related to the retirement, insurance, and hospitalization of their employee, that is non-taxable. All the rest are taxable. Third, benefits given to the rank and file employees, whether granted under a collective bargaining agreement or not. So those given to the rank and file employees may be not subject to tax. Okay. Fourth, fringe benefits which are required by the nature or necessary to the trade or business or profession of the employer, or where such fringe benefit is for the convenience and advantage of the employer. Meaning, the employer really needs to provide this fringe benefits so that the employee can render their services on the benefit of the employer. If that is the nature of the fringe benefit, then that can be non-taxable. Okay, and of course, number 5 is de minimis benefits. So de minimis benefits are non-taxable fringe benefits. So what is a de minimis benefits? So this is exempted from fringe benefits tax. So in general, this may be limited to facilities or privileges furnished or offered by an employer to his employees, provided such facilities or privilege are of relatively small value. Okay, so de minimis benefits are non-taxable, but it should be of small value and are offered or furnished by the employer as a means of promoting the health, goodwill, contentment, and efficiency of his employees. So this should be present so that the minimis benefits will not be subject to income tax. So what are the examples of de minimis benefits not subject to income tax? So we have here the following. Okay, so de minimis benefits, unlike the fringe benefits, this can be given to both managerial and rank and file employees, while your fringe benefits are only for managerial employees. Okay, so these are the de minimis benefits that are not subject to income tax. Number 1, monetized or unused vacation leave. So it should not exceed 10 days, meaning there is vacation leave provided to the employees, but they did not avail it, so they can convert it into cash. Okay, so this is non-taxable, provided it should not exceed 10 days during the year. Second, monetized value of vacation and sick leave credits paid to government officials and employees. So again, this is like number 1, meaning a vacation and sick leave of the employees were not taken, so they convert it into cash. Third, medical cash allowance to dependents of the employees, provided it should not exceed 1,500 per employee per semester, or that is equal to 250 per month. Okay. Fourth, rice subsidy of 2,000, or that is equivalent to 1 sack of 500 kilograms of rice per month, amounting to not more than 2,000. Okay. Fifth, uniform and clothing allowance not exceeding 6,000 per year is non-taxable. 6, annual or actual medical assistance, like for example, medical allowance to cover medical and healthcare needs, annual medical or executive checkup, maternity assistance, and routine consultation, provided it should not exceed 10,000 per year. 7, laundry allowance, okay, but it should not exceed 300 per month. Okay, number 8, employees achievement award. Okay, for example, award for the length of service or safety achievement, which may be in the form of tangible personal property other than cash, okay, or gift certificates with an annual monetary value not exceeding 10,000 received by the employee. Okay, so that is non-taxable. Number 9, gifts given during Christmas and major anniversary celebrations not exceeding 5,000 per employee per year. Okay, so number 10, daily meal allowance for overtime work and night shift but it should not exceed 25% of their basic minimum wage. Okay? And number 11, benefits received by an employee by virtue of collective bargaining agreement and productivity incentive schemes. And provided this should not exceed 10,000 per employee per taxable year. So those are the different de minimis benefits which are not subject to income tax. So please take note of the maximum amount, okay, per item. So we will continue with professional income in the next video lecture.